more and more homeowners are saddled with these higher rate mortgages, and so they're struggling. So I do think that we're slowly sliding into a recession. The analogy I like to use is just of cooling water. Put a hot glass of water into the freezer. It's not going to turn to ice immediately. You have to wait a bit. Unfortunately, that time has come. Absolutely, and that's what helped to cause this bout of recession, bout of inflation that the U.S. and many other countries experienced. But at this point, the impact of higher rates has done its work, and the Fed is now behind the curve. And people talk about how rate cuts will be great news for the stock market. But look at the last two recessions outside of the pandemic. They all began just months after the Fed started cutting rates. This time is not going to be any different.
Where would you tend to put money then right now? I'm guessing that you'd suggest owning a substantial weighting of bonds.
That's right. We expect the 10-year Treasury yield to fall to 3% next year. So that implies quite a bit of upside for bond prices. I mentioned that stock prices are going to go down. So clearly investors should be overweight bonds, underweight stocks. Within equities, I would recommend favoring defensive sectors such as utilities, consumer staples, and healthcare. And also, look a little bit outside of the equity realm.